To a non-finance person, a balance sheet can seem super confusing. And I don't think it really has to be. It can be really quite straightforward when you understand the different components. So let's look at a basic balance sheet here and explain the different components. And hopefully that clarifies things for non-finance folks that need to understand how a balance sheet works. So a balance sheet is split into two kind of sides. You've got current assets and non-current assets on the side for total assets on the left. And that always equals or balances with the liabilities and shareholders' equity. And let's go through the different components. So on the asset side of things, this is things that the company owns that obviously are an asset or a benefit to the company. So assets are also split into two things: current assets, so assets that are either liquid or expected to be available within 12 months, and non-current assets, which are illiquid or not going to be available within 12 months. And so obviously cash is very liquid. You can draw it out of the bank straight away. And in this case, we have 10,000 of cash. Accounts receivable is basically money that your customers owe you. So you've sent them an invoice and they haven't paid it yet. So you've billed for it, but you haven't got the money yet. So that is an asset because at some point that will add to your cash balance. So in this case, there's 3,000 of that. And then prepaid expenses. Sometimes you might buy software for the next 12 months, or you might pay expenses in advance. These sit on your balance sheet as an asset because you've paid for something in advance that you haven't used yet. And so that's considered a current asset as well. So that is your total current assets. And what we've done here is we've labeled that A. Non-current assets are those illiquid assets that I talked about earlier. And the biggest one is obviously property, plant, and equipment. So if you own a building for your business, if you are a factory, or you own some machines for the business, or whatever it might be, for services businesses, that might be computers and desks and furniture and that sort of stuff, that goes into property, plant, and equipment. And in this case, the total value of the property, plant, and equipment, or gross value, was $6,000. Now, in accounting, just to make things a little bit more confusing, we have this concept called depreciation. And that is basically depreciating an asset over its useful life. So for example, if you bought a laptop for $3,000 and its useful life is 3 years, the depreciation in year one would be $1,000. In year two, it would be $2,000. And in year three, it would be fully depreciated and the depreciation would be $3,000. So on a balance sheet, you take the gross value of that property, plant, and equipment, and you less that accumulated depreciation to get to net property, plant, and equipment. And that's the value of the asset basically today. And in this case, total non-current assets add up to $4,500, and we've called that B. So to be simple here, on the asset side of things, basically A plus B, or current assets plus non-current assets, equals total assets of $18,500. And to balance things, there's either liabilities that offset the assets, or shareholders' equity, which comes in two components, which we'll talk about in a minute here. But to keep it simple, let's just go category by category so you can see what's happening. So on current liabilities, similar to accounts receivable where people owe you money, accounts payable is you owing other people money. So you might have received invoices for services that suppliers have provided to you, or raw materials that go into your product, and you haven't paid those invoices yet. That becomes accounts payable, and it's a current liability. Current deferred revenue. This is a concept again in accounting that basically, if you've been paid by a customer for a service or a product that you have yet to provide, that becomes deferred revenue. So you've got $500 of money, but you haven't either provided those services or products yet. That goes on the balance sheet as a current liability called current deferred revenue. And then Any other current liabilities would go here into other current liabilities. That gives you a total current liabilities of $5,000. So we've called that C here. Non-current liabilities are longer term liabilities that are not due in the next 12 months. And so debt is the most obvious one there. And here in this case, this example, there's debt of $5,000. So that makes total liabilities, or C plus D, or total current liabilities plus total non-current liabilities of 10,000. And then the balancing item here to get everything to balance is the shareholders' equity. So that would be common stock. So in this case, $5,000 was used to kind of fund the business at the start. And that was in exchange for shares in the business. So that's $5,000. And retained earnings, which is basically all of the profits that the business has made since inception, is the last kind of balancing item. And in this case, the business has made $3,500 since its inception. That gives you total shareholders' equity of $8,500. And then when you add total liabilities plus shareholders' equity, in this case, you get $18,500. And that a balance sheet always balances. So the total assets always equal the total liabilities and shareholders' equity. If not, there's definitely a problem. And that's many a first-year analyst in investment banking spends a lot of time trying to build a financial model and get their balance sheet to balance. But in the end, it should always balance. There's always a counteracting or balancing item that makes a balance sheet balance. Anyway, I hope that demystified the balance sheet a little bit. It is complicated, but it's more complicated than it sounds in most cases. If you have any questions, definitely post any comments. If you like this video, feel free to subscribe to the channel for more great content around understanding financial concepts and entrepreneurial kind of videos. Anyway, thanks for watching and see you in the next video.